Welcome to Money Convos, where we discuss personal finance and investment tips. We're committed to helping people create wealth and achieve financial freedom. Follow us on Twitter, Instagram, Clubhouse, and Facebook, and subscribe to our YouTube and podcast. Alright then, let's head into today's conversation.
Okay, I see we have some people who have joined, so we'll go ahead and start. Hello, Courage. How you doing?
My pleasure. Good evening, and good evening to everyone on here.
Great. Good evening, Courage. So today we are having a conversation about what's going on with the Cedi, and there are some other issues going on in the Ghanaian economy that we can discuss. First, let me issue a disclaimer. I'm doing a bit of traveling, and I'm stuck out somewhere, trying to get into a library, but I couldn't get a quiet space. So I'm sitting out somewhere outside near a roadside. So pardon any background noises that there may be. I try to mute it as often as possible. Okay, great. So Courage, first, maybe you can do an introduction. This is the first time that we are having you joining us on Money Convos. I know you to be my big brother from the time when I was at my previous institution, your previous institution also. You served as an economist, very knowledgeable. You feature on a lot of TV shows and radio shows explaining things to people. But perhaps maybe you can tell our audience what you do from your point of view.
Thank you, Alikem, and I'm grateful for the opportunity to share some insight with our cherished listeners here. Like he said, I'm Courage Kwesi Boti. I'm an economist by training. I worked as an economist and fixed income analyst with DataBank for some 6 years. That was where I met Elikem, and we had some good time together, really. I appreciate him for his thoughtfulness, his deep insights, and his critical views on things, really. And he was one of those people you will always have conversation with and walk away happy that you've had other perspectives, really. Currently, I'm the lead researcher and an economist at GCB Capital. And GCB Capital is the investment banking subsidiary of GCB Bank Limited, GCB Bank PLC. My core duties, I cover the economies of Ghana and selected African countries. My focus areas are on macroeconomics and fiscal development, and of course, debt market development and things related. And the sole goal is to put out an opinion on some of these developments to inform investment decision making for fund managers, policy makers, and anyone who cares to read, really. Once a while, as part of the things I do, I share my thoughts on developments in Ghana and elsewhere on the local media and international media space. So if you came across that name, Kariboti, on any of the media channels, I was just doing my normal job, really. I think that is a brief about me. As we go on, my aspirations as we stand, I'm looking to start a PhD program soon in the area of economics and finance, and I'm working assiduously towards that. So if there is anyone on this call that could offer help, yes, we could talk afterwards. And if there are any questions related to anything I do, I'm happy to fill them even outside of this forum. Thank you, Alikam.
Thank you so.
Now I'm looking forward to the conversation here.
Great. Thank you so much, Courage. I asked you to introduce yourself. You are trying to hype me. Please, I'm a very, very humble servant. You are the boss. We look up to you, and I'm looking forward to that day when we can see Dr. Courage Boti. Well end. All right. So.
Trusting God. Yeah.
Great. So to anyone who just joined, today we are having Courage Boti. He's an economist. He's with the GCB Capital. But the conversations we are going to be having today are his own personal views. They shouldn't be considered as views from GCB Capital. They should not be considered as investment advice. None of the things that are said here should be considered as investment advice. It should be information to add on to your knowledge, and you can see your own investment advisor who can give you tailored advice if you so desire. Okay, so we can head into today's conversation. Anyone who has a question along the line, just raise your hand, request the mic, or send a message, and we would invite you to ask. So, Courage, Is the city out of the woods? That's what we are talking about today. But even before we get to that, we'll build up to that ultimate question. But first, how do you feel when you saw that the city suddenly jump so high? There was a first spike in, I believe it was like in the 20th of February, stayed somewhat stable. Then in July, August, it jumped up way more. How did you feel when it was going up, and even more so, how did you feel when it started coming down? And here, this one, talk to me as a lay person before we turn on the economist hat.
That's fine. So I must say there is more or less a genesis to this. I wasn't surprised when the city started depreciating so sharply. Maybe the only surprise was the September, October, and most importantly, November period where it looks like a free fall. That was when, even that, it wasn't surprise. It was just about how low it was sinking. In September 2021, the IMF did what they call Article 4 review, and they do this for every IMF member anyway. If you are not under a program, it's like an auditing. They come audit your accounts and they put an opinion out there on what they think about your books and what your finances are and the issues that needs addressing. In that Article 4 review, I think what came out clear is that Ghana is at the risk of debt distress. But then it was within manageable limits. And so we needed to deploy some macro-prudential policies to try to restore debt sustainability. By the way, when we say you are at debt distress, it only means that your chances of meeting your obligations to your creditors, if you like, interest payments when they fall due, principal payments when they fall due, your chances of meeting those obligations on time are limited or are reduced or is challenged because maybe your liquidity position is not as strong. And if you look at Ghana's finances from 2021, if you take things like the interest we pay on the debt we borrow, you take things like the wages we pay public sector workers, and you take something like goods and services used at public institutions, really, those alone were consuming more than 100% of the revenue we generate in any single year. For the year 2022, as at September, it was about 130% of total revenue, those three items combined. What it means really is that without doing any road construction, without doing any capital project that is growth enhancing or development enhancing, really, just taking care of the necessary bills, the recurrent items alone, the tax revenues we raise is not enough to do that. We have to borrow to even meet those obligations. And naturally, when you're in such a situation, you will borrow more. And so if your revenue has to be channeled into other things other than that, these recurrent items, then there is a risk that you may not be able to meet your debt payment. That was really the issue that IMF flagged. So from September, you saw foreign investors who had holdings in Ghana started moving out of the Ghanaian economy. As at that point, the total offshore holding of domestic bonds we issued in Ghana was about 34 billion cedis. From that time up to September, when the budget was being read September this year, as reported in the budget, that foreign holding reduced from 34 billion to a little under 17 billion, really. That is more than half the exposure foreigners had to Ghana being repatriated. That pressure will naturally put your city down. And then, of course, you had the situation where people go with a bandwagon. Traditionally, we import a lot, even an oil import bill for the year 2022, because of the Russia-Ukraine situation, which mean oil supply on the market was limited. And there was ban on Venezuela, really, from the US, and a number of other structural or supply chain disruptive issues that meant that we could not get so much oil on the market as would be desired. We saw oil prices jump to about $128 per barrel, and that is the peak. And then, Ghana, we import almost entirely our refined oil, which is relatively more expensive. So whereas we are net exporters of crude oil, we actually import most of our oil needs. And so the gains from those price appreciations were very marginal, if any at all, because whatever we gained from crude oil export went back into importing refined oil. And so that alone even imposed some pressure. And then the usual stuff that we do not produce enough locally, and so we depend a lot on import. All of these factors combine and put pressure on the cedi. And that is why you saw the kind of decline we saw in the first quarter. Second quarter, I believe towards the end of March 2022, government had a retreat and they did some resolutions. That meant that they were cutting back on some expenses. That was when they announced 30% cut on discretionary expenditure. They announced 30% cut on the salaries of government appointees. They announced the ban of the use of V8s and a number of other measures that were supposed to impose some more discipline. The market responded. I'm sorry about that. My little girl is giving me an issue, but I think she's fine now. Yeah.
The usual backing.
The market responded exactly, and we saw some fair stability in second quarter all the way to I think somewhere July. But it was in July that it became obvious that, and I think July into September, government announced in July that they are going to the IMF. E-levy, which was supposed to be a savior and bring in so much revenue to close the revenue gap, turned out to have underperformed really spectacularly. And there was no choice but to now go to the IMF, which we could have gone anyway earlier as a precautionary measure. But in July, we had to go as an emergency. And then I think in early September, Bloomberg published a story that said that Ghana could be doing debt restructuring and even put some figures to it that said we could lose about 30% of principal of our bonds, really. That set the whole market on edge. And the reason we saw the sharp decline from September thereabout, and it firmed up from October, late October, November, all through, because then there was talk about debt restructuring, there was talk about losing principal, there was a lot of uncertainty in the system. And if you had some investment still left with GOG, that was time to move it out because you do not know what is going to come next. And so people were doing those. I wasn't surprised because everything the IMF said earlier, which we are aware of, pointed to the fact that we could come to this kind of situation. And the currency is the most responsive indicator when it comes to shocks. Whenever there is uncertainty, wherever there is problem, currency will react first before every other thing follows suit. And so with all of this noise in the air, no certainty as to whether government can honor its obligations, you look at it at half year in September and you realize that those three items I mentioned earlier were consuming all the revenue we raise and we have to borrow to fill the gap. And you look at the growth in the debt stock, and especially over half year, where the depreciation meant that we have added about 60 billion to our debt stock without new borrowing, just by the fact that we had some external debt and depreciation affect their nominal value. People were naturally on the edge. And so if you had some investment, you sell them off. From September, about 4 bonds matured. I think 2 3-year bonds and 1 5-year bond matured. But because market was unfavorable, the government actually did not roll them over as they will usually do. So they paid off, and they paid off from some liquidity they got from the Bank of Ghana. Now, those monies went into people's hands, and they decided to channel them into FX. Speculators were also thriving, and so they pushed the cedi where it was. I think the feeling was that it was self-imposed. The feeling was that we could have avoided it because the warning signs were there. If we took precautionary actions earlier and then maybe got a program with the IMF as a backbone, given we were shocked severely by COVID, and in 2021 we were trying to recover, but there was no credibility, there was fragility. So that would have been the time to go to an IMF that supports us in our recovery efforts. If we did that, we did not have the kind of situation we had early in quarter one, and then which continued from September, really. So for me, to answer your question more directly, the feeling was that we inflicted on ourselves that kind of trouble, and investors were just being rational, protecting more significant losses, and they were doing so by cutting their losses so that they can go in peace.
Wow, that's a very good recap of all that happened and why it happened. I hope our audience picked up on that. from the root causes, and what really hit me was about the part about it was self-inflicted and we could have avoided it. All right, well, what's done is done, and we are in this situation. We are thinking as investors and how we can act, how we can preempt other things, how we can react in this current situation, right? But still on the topic of what happened, right? I'm more curious about the recovery, Courage. First thing is the speculators, the issue of speculators. They are the real things that you spoke about, investors who are getting out and they were actually moving money out. We've heard about speculators. The government and other people have spoken about it. How much of an impact did they have in this up and down?
Oh, it is huge. I can't put figure to it because these are not things. You see, when someone goes to the FX market to say, I want to buy some dollars, I want to buy some euro. In fact, in very civilized jurisdictions where systems work, you are supposed to declare the intent, what you need the money for and all of that. And I believe some people who have traveled outside Ghana might have experienced this, right? In our place, I think all you need is your face. Walk to a counter, carry some cedis and say, I want some dollars. Really, the systems are not that rigid for you to declare your intention. So you can't put figure to what percentage of the demand is out of speculation and what percentage is out of effective demand, really. But the reality is that most people were on edge, and whoever does this as a way of avoiding a risk is speculating, including investors. And if you saw about 17 billion out of the 34 billion foreign holdings of GOG bonds being de-invested and repatriated out of the economy, really, that is the clearest sign that there is some uncertainty and people are not sure what it's going to be. So they'll be doing that out of speculation. If someone is buying to keep under their pillow for future reasons, it will be out of speculation. And one thing, we haven't seen the usual seasonality effect that normally is associated with quarter four this time round. And it is actually famous close to Christmas, from November, late November, all the way to December, where you would imagine that importers are bringing in goods and all of that. But the reason is this: when the problem started from September proper, everybody envisaged it. So those who import for Christmas started doing it way back. And so you are not seeing the usual pressure around this time. But they were doing so because they speculate that the Cedi could get much worse than it is now. So while I cannot put the exact figure as to what it is, I can say anecdotally that it is very significant. And for the investors, for the traders, for the corporates, and for every other person that tried to hedge his FS position because they fear the worst, they are speculating, and that is adding to the pressure.
Thank you, Courage. I like how you've defined speculation. How about traders, people who are using derivatives, just betting against our currency?
That is also a big part of it, right? So there are those who are just in it as a game and those who are doing it for the sake of their business. You would see in our part, it's not common as an official thing where people are placing bets. It's more common in places like the US and the more advanced markets. But yes, I mean, people did that. I know a few people, like I have, this is an example, personal example. My brother is on peacekeeping somewhere in Sudan. And when he heard the Cedi was on a free fall, he asked me that I should call his wife. He has some money in his account. He should withdraw it for me, so I change it into dollars and keep for him. And I remember telling him fondly, and he didn't like it till date, that for every Cedi you change into dollar, you think you will be making gain, but you are adding to the problem and will all pay back in higher inflation. When I said that, he was like, I mean, why are you acting like you are more patriotic than anyone else? But it is actually factual. And if you see November inflation jumping to 50.3, depreciation is the big part of it. But I'm digressing a bit. I'm trying to say that a lot of people saw the trend and realized that, okay, it could get to this level, so let's strike. And they actually did purchase dollars and kept against those ones. So it's all part of the issue. The thing is, we do not have data to back some of these claims and to segregate them to say this is the percentage that is due to betting, this is the portion that is due to speculative trades, this is the portion that is due to maybe some people doing business ahead of time. But the reality is that all put together, these factors contribute to what situation we had.
Courage. The part you said you were digressing, no, I like that part. We had a conversation some weeks ago about the impact of people buying dollars affecting the Cedi and it's hurting our economy. Can you repeat that part just for emphasis? And Dennis, note this part down, right? Just for emphasis. What did you tell your brother?
So what I told him is that for every Cedi you change for dollar, you are actually adding to the problem. And let me explain that a bit. The reason is this. You see, we import most of the things we consume locally. And for crude oil at the pumps, there is a pricing formula. That formula has in there the margins the distributors will charge, which is fixed. It doesn't change. Then the exchange rate. And of course, the international price of crude oil. So if the Cedi is falling by 2%, 5%, 10% every day, when they bring the oil marketing companies bring that oil, they will put whatever exchange rate is prevailing at the time into that formula to determine what prices they sell at the pumps. Now, the traders on the market, the cassava, the beans, the palm fruits, and every other farm produce and any other good you see on the market, they are transported from one point to the other. So that higher fuel price translating to higher transport costs will filter through to the prices on the market. And by the way, those goods that are even being imported, beside the inflation in the economies they are importing them from, they would have to pay duties on them at the port and they will buy them at higher cost because they have to change more cedis to get the dollars to import the same quantities of good. And the price is such that the next month when they go to import more, they'll be able to take the same quantity. So depreciation will feed them. So whereas you may be making returns about maybe 30, 40% on your dollars and be happy, that returns you are making will go back paying higher prices on the market because, and it may not even be enough to make up for the price increases you see on the market because the depreciation which you are happy about as an investment is triggering inflation, which we don't have to pay for. It's the only reason inflation could jump from 7.5%, or part of a big part of the reason inflation would jump from 7.5%, I think around May last year, to now 50.3%. Really, a big part of it is Cedi depreciation. Another big contributor is oil prices and how it's filtering through to transport fares and all of that. And then the supply chain bottlenecks as we know it, really. And so that is how our actions contributed to the inflation. So we were actually imposing on ourselves higher price by being greedy with hoarding some effects.
Wow, my brother, thank you for that. I hope everyone heard that explanation. It seems abstract, but it's when we talk about it generally, but you've given a very good breakdown of how our actions feed in to affect the whole economy. Okay, so let's move on. Looking forward, we've gone up, we've come down. We are sort of back to square one, right? So I ask you, is this sustainable? Should we expect more volatility ahead? Or what are some of the signs? You can say that, okay, if this happens, then we can expect this to go this way or that way, you know. What do you think?
The answer is a firm no. We are not out of the woods. The reason I say so is this. In any case, where we are now actually doesn't even restore normalcy. You know, we started the year on the retail market with the Cedi changing at 50 pesos to $1. So even where we fell back to, or we appreciated back to, which is around 8 cedis, if you look at it relative to where we started the year, that is about 1 Cedi 50 pesos addition to that rate from where we started the year. In percentages term, that would be about 24% depreciation, which in itself is alarming normally, right? And so we were not really back to where we were. And the reality is that today the rate started going up again. I saw early this morning, some institutions printed 10 cedis to $1. And midday, they revised their rates. I've seen some quote 10 cedi 75 pesos, others 11. Some even went as high as 12 cedis to $1. The simple reason is this. Speculators don't give up. If there is a sense of a sense of positivism, which is driving the momentum. When you are speculating, you are doing so to make profit. And so there has to be a trigger point. The trigger point was that the Cedi seemed to have stabilized around 15 cedis, and the news coming in suggests that there could be some sense of stability going forward. We've reached a staff level agreement with the IMF. The Bank of Ghana has pledged that they will keep supporting the Cedi until we conclude the deal with the IMF, and they kept true to that. They've tightened regulations. There were talks about ways to substitute gold for oil. Well, however sustainable that is another subject for discussion, and all of that. So the general notion was that if all of these things come true, the Cedi could be strengthened or could gain stability going forward. And so that was a trigger point for those who bought at 10 Cedi, 9 Cedi, 8 Cedis to start selling so they can make some profit. And once we are following the momentum, everybody is selling, it is falling, so you might as well sell before everything is eroded. Your gains are eroded, really, and that is why people were selling. But there will be that point where you want to test the system to see, do they really have the liquidity to support this kind of movement? I think is part of the problem we are having now, where the Cedi is going back up again. Another thing is that there was a very market-unfriendly news yesterday, or at the start of the week, that was Monday, when government says it's suspending interest payment on some external debt that include Eurobond, some commercial debts, and most bilateral debts, really. Now, that in itself is default, but default is a technical term. When you say you default, bond prospectors will define what default means, and there are conditions to default. One of those include not meeting interest obligations when they fall due. And for the Eurobond prospectus, it says that when interest falls due and within 15 days you haven't honored it, you've defaulted. That's technical default. Now, what we have at now is government signaling that I will default going forward. And it took effect from, I think, yesterday, 19th, when the announcement was made. But the reality is that in technical sense, there is no default yet because no interest has fallen due and government is unable to honor within 15 days. So that is why you see S&P today or yesterday announced that they've rated Ghana in the category of selective default. And whenever actual default happens, vis-a-vis when interest falls due and they are not able to pay, then they'll change it to actual default, really. So practically, we have defaulted. And if you default, it is actually the market punishes you for that. And so if it were the case that people could sell their remaining local bonds easily and move out, you will see a lot of pressure on the market. If it were the case that those Euro bonds are held on the CSD locally, then you would have expected that the sales would have generated a lot of demand on the FS, then there will be pressure. Thankfully, those Euro bonds are not hosted on the Ghanaian CSD. Most of them are on the Irish Stock Exchange and, of course, the London Stock Exchange and all of that. So the impact of such run or such movements would not be felt almost instantly. But what it will do is that anyone who is in two minds as to whether to move out money or not, these are signals, sure signals to tell you to start moving. And I want to think these are part of the reasons maybe we could see pressure again going forward. And it's already started from today. So we are not out of the woods. It's early days yet. We have to see tomorrow and then the days coming to see what pace this will happen at. But to move from 10 Cedi to 10 Cedi, 75 pesos in a day from a credible bank is actually a big jump. And I've seen rates at 12 Cedi again today. So we are not out of the woods as things stand.
Okay, that's an emphatic no with a good explanation. Thank you so much for that. It's good to understand the things that will cause the movement. It's not just about people just looking at the numbers, saying, oh, the Forex Bureau said it's gone up, the Forex Bureau said it's gone down. But it's good to have this understanding to know that it's gone up or down because this is what happened. Thank you so much, Garage, for that. To our audience, I encourage you to ask questions. Raise your hand, ask questions, or request the mic, or you can send a DM to the account and we would answer any questions you may have. All right. While we are waiting while you're waiting for any other questions, I will continue to ask the questions that we had planned. And Courage, this one, I want to ask you a question that someone asked me was it yesterday? I was telling someone about what's happened in Ghana. And she's African American. She doesn't know too much about what's going on here, and doesn't have a business background. And a very simple question, and it actually made me pause. And this is how it goes. Okay, so with all that's going on with the IMF and the debt crisis, especially on the Eurobond side of things, how does it affect the average person, especially someone who is not an investor? How does it affect the average person?
Well, so how does it affect someone? Let's start with how it affects investors, because that is more obvious. Now, for investors, you invest because you are putting away your present consumption for the future. And your compensation is that you will get some interest that would at least preserve the time value of your money, and something small on top to compensate you for deferred consumption, really. And you want to do it in a very safe or relatively safe environment where at least your investment can be guaranteed. If nothing at all, you can get your principal back, and of course hope for some interest on it over time. So you do that decision carefully, especially for fixed income investors. You want to preserve your principal, right? And so whenever there is developments like this where a sovereign is having challenges and is not able to pay, what it does is affect your life savings, sometimes pension funds. So for instance, if maybe a BlackRock is investing some pension funds in government of Ghana Eurobonds, and they are heavily exposed, and such a thing is happening, you are not paying interest, and maybe even if what we heard from the deputy minister is anything to go by, they are thinking of some 30% cut on principal and some reduction in the coupons they will pay on those ones. What it does straight away is that it affects how the ability of your fund manager to grow your investment and what quality of life you can have in the future. With what is happening now, it means that you can't get your money when you ought to get it, and that affects your expenditure pattern on your choices on what to do or what not to do, and what opportunities to take advantage of or what you cannot take advantage of, really. If you look at it from the domestic side, where no interest is being paid in 2023, any fund manager that would depend on those flows for liquidity would have to look for an alternative way. Any fund manager that is looking forward to those flows to diversify would have to look for an alternative, or to take advantage of some very juicy opportunities to improve or returns on those funds would have to look at an alternative way, really, if there is any at all. And then tenor is extended beyond what you expect. So even if you have the bond, per the schedule as it stands now, 30th December is the deadline. So if you have a bond maturing on 16th June, which is true, there is a 5-year bond maturing on 16th January 2023, just a few days to the maturity, you are not getting your principal, assuming you put that money away in the hope that maybe by the time it matures, you use it to maybe buy some land, do some project, or do something of note for you. You are not getting it because government says I'm extending the tenor. So it affects your choices, it affects your returns. And for the local market, already we know in this Ghanaian economy, salaries are already low. Most people earn peanuts in retirement. And for the teachers, for the police people, for the nurses, and people like that whose salaries do not take them home at the end of the day, and are hoping that their little pension contributions can sustain them in the future, by this unilateral decision, you are actually getting very meager returns over time, which makes you even much poorer in retirement. So it affects you directly. For someone who is not an investor, I think what we have done so far means that there is so much hardship in the economy that if that brother, that sister, who you depend on for some Cedi or so to do something, some support, some financing your education or stuff like that, maybe because they are taking so much hit, they will have to find monies from elsewhere to even deal with their own lives. The stipends and the things they channel to you may not be able to even come your way. For government itself, we have had to go to the IMF and face some strict conditions again because we have been indisciplined and we have had to do some of these things. IMF naturally would say, do not do commercial borrowing in a few years to come. And so your project, capital expenditure to create new jobs, to expand the economy, your ability to hire new employees for the many people graduating and looking for employment opportunities, you could not have companies investing so much to even expand their capacities, and that will affect your chances of getting employed. For the banks, they are taking huge hits. It will affect some jobs. For the fund management companies in particular, your business is mobilizing monies and managing them to get returns, then you get paid for management fees. With all of this happening, we've eroded confidence in the market, maybe back some 10 years. And so you will struggle to mobilize deposits now, which will even give you the fees that you can even employ more people with or pay. So the effect or the impact is quite wide. And some of them we cannot estimate because they are direct and indirect. And so it goes to affect almost every facet of our economy because government cannot spend the way they have to spend. Individuals may not be able to fall on the money they need to do the things they have to do. And it imposes hardship on everybody. That mason that is waiting for you to start your construction so he can also get job because your money is locked up, the construction will not start, he is home and he's hungry. That person depending on your expenditure as a catalyst to sell something on the market because your money is locked up will not get the demand on his goods or services. And so we are all invariably affected directly or indirectly.
Wow. When you go to the part about the mason who's waiting for the house, for the money to come for the construction to begin, and because of that he's hungry, it hits in a different type of way. So yes, nobody is unscathed. Everybody will feel it, whether you're in the formal economy or you are in the informal sector, you will feel it one way or the other. So we'll start wrapping up the conversation soon, but I encourage anyone in the audience to have to ask your questions either via direct message or raise your hand and I'll invite you to speak. Today we are having a conversation about is the Cedi out of the woods with Courage as an economist, and he's given us a good rundown of how we got to where we got to, what caused the Cedi to depreciate so drastically, what caused it to appreciate in the last couple of weeks. And he's also given his outlook for the next couple of for the future. All right. So if you have any questions, you can just ask. And Courage, perhaps a question I have for you as we come to the end. It's been a lot of doom and gloom. Yeah, pardon me. Yes. So Courage, it's been from what you've said, especially when I asked about the whether it's sustainable. And we are out of the woods. It's been a lot of doom and gloom. Do you have any positive thing that we can look out for as this is going on?
So at the end of every storm, in fact, when the dark beyond the darkest part of the night is actually daylight, right? And I believe when the battle is fiercest, it means you are closer to the end of victory, really. And those are the points where you do your best. I think what is happening now could be a catalyst for very sound, stable macroeconomic and management, and we'll learn a lot of lessons for the future if we will learn them. Because debt is a problem. If you are forced to do debt restructuring and we succeed in the form we are trying to put it across, what we will do, the IMF is giving us the daunting task of reducing our debt to GDP to about 55% of GDP by 2028, and to reduce external interest on external debt to GDP to about 18% by 2028. And those are actually performance criteria we need to meet to pass a program. And there must be, the program won't last till 2028, but we would go all the way till starting from 2023. So we'll go all the way to 2026. And between 2026 and 2028 is about 2 years. So you would have seen most of the progress within the lifespan of the program, really. If we succeed and we get, and I read from the creditor committee of the external creditors, they are released last time that they are actually willing to cooperate with government to do this. It looks like they understand the problem and the need to negotiate or dialogue, but they are also drawing the fine lines that it must be fair negotiations we must actually burden share in a reasonable, fair way. It doesn't have to be they being overburdened. And of course, a number of other things they are outlined, which I thought were diplomatic ways of saying you have to also do your bit. And so if all of these go down properly and we do the right stuff, we will come out of this program with clean books, sound macro fundamentals, lower debt burden, and that will be a catalyst for stable Cedi. In 2023 in particular, once we succeed, and now getting board level approval is actually dependent on our progress with domestic debt restructuring, which is facing a lot of resistance from a lot of people. The reason I believe is even extended. But if negotiations go well and we push that through and all of that and get a program, in 2023, the budget is supposed to be financed entirely from concessional financing, development partners. These will come in dollars. I see 61 billion. I know that figure will come down once they take out the interest payment as they are seeking to do. But even if it is half of that amount, it will come in dollars. Now, that would actually come and shore up your reserve. And of course, you are also seeking, and what that is as another precondition, that you get financing assurances from development partners for the program. IMF wants you to assure them that it is not only IMF that will fund your development needs within this era, you are getting assurances. And if you succeed in getting that, those are also monies that can show up your reserve. And then there is a talk of swapping gold for oil. Gold, oil import on our bill as it stands now was about 3.9 billion as at September also. Now, if we have enough gold, and I say a big if, because I see the gold export bill and it is just about 4 billion. And what the proposal they are putting across was for the big mining companies to sell about 30% of their gold they are produced to PMMC and then Bank of Ghana and all of that. So if the total bill is about 4 billion, 30% will not get close to the 3.9 billion. But they claim they have enough gold to do this. Assuming that is true, we are taking $3.9 billion off the import bill. That is money that can show up our reserve. Or even if it is half of that, that would have been a good saving on import that could show up the reserve. So what matters at this point, I believe, is getting IMF board level approval. And then some of these funds that are contingent on it to start flowing in, then we can explore the other options available to us. If these are set and we are not having to pay interest next year, assuming the debt restructuring with external debt holders go well and we suspend interest payment for 2023, then we could create a lot of room to support the Cedi, and then there could be some sense of stability, really. So it is not all gloomy. Maybe in this time it seems so, but if all of these are rolled out and we succeed in doing meaningful debt restructuring and carry out reforms that may be encompassing enough and that can stand the test of time going forward, then we could come out of this whole problem much stronger, better prepared to deal with shocks going forward. And that should be a catalyst for a more sustainable economic management going forward. So there could be positives even in the storm, but it depends on how well we do it and how we deal with the problem as it stands now.
Okay, great. Thank you for that. At least, like you said, in the darkest of the tunnel, what you can look out for is getting out of the tunnel, and it's really about us putting in the work, the necessary work that it will take to do. I had a question coming in, but I think you've answered it somewhat similarly. What's the worst case scenario that could happen? You answered in a sense of this is how. We are not out of the woods in your explanation there, but I'm curious though, is there a worst case scenario that could happen? Or that's what do you think?
You see, if God forbid, if debt restructuring does not go the way, you see, if you look at the 2023 budget, we are expecting revenue of, I think, 143 billion. But out of that 143 billion, about 52 billion is interest payment. So take that out and you realize that is almost 50% or just about, it's close to 50% of the total revenue you expect in a single year. Clearly, that is not sustainable. So if you add the other things, you are in trouble. And that is the kind of reactions we had. The hope is that debt restructuring will be successful, and then you can create fiscal space. So if you take out even 70% of that 52 billion in interest payments, you would have reduced your deficit significantly, and you would have created room for some social spending that can help grow the economy and support lives and livelihoods. So if debt restructuring doesn't go as planned and the domestic market refuses, in the first place, you are not even getting an IMF deal, because the IMF deal, board approval, is contingent on you doing domestic debt restructuring. So if it doesn't succeed, we are not getting the deal. And you see, you can't imagine 2023 without IMF supporting us, balance of payment support, because the reserves are depleted, and it's the reason they are suspending interest payment on external debt. The statement said it, that the reserves can no longer export that. The figures we are seeing are alarming. Net reserve is just under 2 billion, really. And so you cannot survive as a nation without reserves and without all those flows supporting you. And you see, the bilateral and development partners financing is also contingent on you getting an IMF deal. And IMF has a principle: we won't give you a loan if your debt is unsustainable. And clearly the debt sustainability analysis says that our debt is unsustainable. So the consequences will be very dire. And I guess that is the worst case scenario if we cannot push through the current domestic debt exchange program, even if it means varying the terms slightly to ensure buy-in. We do so that we can get the buy-in and execute it so that we can secure the program. If we do not, the consequences may be much more severe than we saw in 2022. And I'm not a doomsday prophet. I think it is actually fact, and it's quite straightforward. We will be in much more difficult situation than we were in 2022 if we cannot get an IMF deal in place.
That's great. So everything hinges on the IMF deal and going through it successfully. Wow. Well, we'll keep our fingers crossed and do what we can, which is, though from where we sit as individuals, very little. We just keep putting pressure on the government to do everything that's necessary and positive for our long-term good. Courage, I would like us to wrap it up with one last question I have received. So what should an investor do? What should the lay person on this conversation, listening to this conversation, do?
For a lay person on this conversation...
Oh, and sorry, Courage, pardon me, before you come in, again, let me rephrase the question. This is not investment advice. This is not investment advice at all. It's encouraged that everyone should go and have a conversation with their own investment advisor who give them tailored responses that would factor in their own personal circumstances. But in your opinion, what would you tell your brother, just as what you told your brother earlier on?
Exactly, and I was going to just re-emphasize what you just said, that for an individual who is concerned about how this is affected, it is case by case. For instance, some types of debt are excluded from the domestic debt exchange. Individuals holding bonds, people in treasury bills are excluded, at least for now. And so to start with, you need to know where you belong. If you are in a mutual fund, if you are in any other thing that is exposed to this domestic debt exchange, the solution may not exactly be the panic withdrawals that we are seeing. What that does is you are even reducing the value of those investments for the others that are remaining. You see, because I have to sell to give you money, but I'm selling at very reduced prices, really. And so the potential gains, those remaining, those who are keeping faith with me could make in the future, is reduced because I have to sell a significant portion of that fund to sort you out. And it's the reason SEC came out with the map to market directive. And so I think the best thing is to be calm and then seek the best possible advice based on your personal circumstance, where you are exposed, and then we can talk about what to do or what not to do. And of course, the decision is yours because it has to make sense to you. So call me. You can hit me up. I'm on Twitter at Carigio_B. You can call my company, GCB Capital. We are on all social media handles. We'll be happy to help you. In fact, you can talk to any fund manager or any investment advisor of your choice that you are sure with. Sit down, discuss your peculiar circumstance, and then we may be able to help ourselves. As for the Cedi and then dollar purchases, I won't say don't buy dollars because you are within your right. And if you need it, absolutely need it, yes, you want to do that. But do not do it out of speculation because we will all be adding to the problem. If you do it out of speculation, like I said earlier, my advice to my brother, you would end up paying more for the goods on the market, which the returns you make on such dollar investments or speculative action might not be enough to even make up for. So let's do it cautiously. Buy dollars when you absolutely need it, but not because you're taking advantage of the market. And seek knowledge yourself, right? And it's important when you are doing this. Learn the basics about budgeting. Learn the basics about managing personal finances. That is the only way you would realize that you would ask yourself critical questions that this thing I'm going to buy, is it absolutely necessary? Especially when people are losing money. And with everything happening in the financial sector, there could potentially be job losses, really. Look at how the banking sector cleanup went. It wasn't intended that people lose their jobs. It wasn't intended that the consequences that came up will come. Of course, to some extent, some were predicted, but not to the scale that it happened. But to date, from 2017 till date, there are still people home who are casualties from the banking sector cleanup and are struggling to find their feet. And there could be similar other ones. So if you depend on someone who works in such an industry, you want to learn to be prudent. So you know how to manage the little resources that are available to you and where else to channel them. So you spend on necessary stuff, the ones that will enhance your personal life and make life more meaningful for you, not on things that are not especially enhancing. And of course, satisfaction is in your mind and it's in your heart and all of that. I'm trying to preach prudence here. So learn budgeting. You can take online courses on that. Learn managing personal finances, and then you'll be able to also determine, even in your own corner, what to do with money and not to do, and seek advice on where to place your funds now, because you could be exposing yourself to some risk you never thought existed. So seek best advice before you do so. I think that is what I will say at this point. If you have a peculiar issue you want addressed, I believe Elikem can help. I'll be more than happy to help. And you can call your fund manager or investment advisor and they'll be happy to help you.
Courage. Why you need now? You've done everything. I don't even have a summary to follow this or a conclusion to follow this. Let's pre and close because you have given a good summary. I just encourage everyone to just follow us on social media, on our various social media handles, and follow Money Convos on Twitter, Facebook, Instagram, and also follow Investment Friend on Instagram. Investment Friend also has offers tailored investment advice, especially for women, targeted at women. But everyone can benefit from these. So follow them, and also follow Courage on Twitter or wherever you would like to reach out to him. And remember, go have a conversation with your investment advisors. A last piece of advice I'll give to people too is, we said this some weeks ago, if you have treasury bills, you have treasury bonds, go check on that account. Make sure that it is held as an individual account so that you don't lose out before the deadline comes. Make sure that you have all the statements. You ask for the CSD statement, Central Securities Depository Statement, so that you won't be affected too hard. Thank you so much, Courage. You've been a very good resource in this conversation. You've exposed a lot to us, and I look forward to more engagements with you on this topic. And on the other one, on the path towards the PhD, so that I can call on my friend and say that, oh no, he has a PhD, not just any economist not just two masters, not just two masters, but also has a PhD on top of all that. You get what I'm saying? So I look forward.
And I look forward to that. Thank you for the opportunity. Yeah, and I really appreciate it. Yeah, let's do this often. All right, and these days, I'll be joining, even if I'm not speaking, I'll be joining to follow the conversation. Yeah.
Thank you. Thank you very much. Thank you very much. Okay, guys, thank you so much. I see that there are many more questions, but we can't take all today at this time, but I'll note them all, and then in subsequent conversations that we'll have related to current trends, we will attend to all those questions. Thank you so much for joining in this midweek. And I wish you have a pleasant rest of your week. Goodbye.
Thank you for taking the time to listen to our thoughts. I hope you learned a thing or two and start practicing. Don't forget to follow us on Twitter, Instagram, Clubhouse and Facebook, and subscribe to our YouTube and podcast. Do tell a friend about Money Convos so we all become wealthy together. Talk to you soon. Bye.